All right, happy hump day, everybody. Geico Camel Day. Hope you are all doing well. A lot more of the same in terms of market activity today, right around the flat line. Been in the green most of the day, but just very slight, nothing big. There was obviously some really big news today. We got CPI report, which came in a little lighter than expected. Markets initially rallied on that, now given some back. And then all of the talk between China and the US on the tariff talk. President Trump said everything is all but a done deal, just they have to sign off on it. I'm not sure the market buys into that just quite yet, or if they do, they were anticipating a deal because we're not really seeing any changes going on. VIX continues to make new lows over the last 3 months. We're at about 16 and a half. Okay. And really, other than that, there is not a lot going on. Volumes are really, really low. Any of you that joined us last night for our coaches roundtable, you'll know that we had a significant portion of our conversation towards the latter end on not over trading. And this is the perfect environment that is a trap, especially for newer traders where, man, you're getting tired of just sitting around and looking at your screens, and you want to do something and you want to get the mojo going, right? And you want to be in the game. So maybe you force a trade here, force a trade there. It is a recipe for disaster, everybody. It is a recipe for disaster. So if you feel the need that you have to trade right now, you are probably better off walking away from your computer and going for a walk, a jog, workout, whatever it is, because it's when you get into that mode of I gotta do something, that's when the decisions usually are not good ones. Yeah, Gene, most of us have no patience, to be quite honest with you. It's really something that you've got to learn and just get accustomed to, especially now. We've been through the last couple months where it was really, really super busy, right? Lots of opportunities all the time, lots of volatility. And now over the last week or so, boy, oh boy, that has really flipped. So good time now. Take that walk. Go take the dogs for the walk, whatever it might be. But don't get yourself into trouble with that old acronym FOMO, the fear of missing out. Okay, guys, so we're going to continue from where we were. Yeah, sit on those hands. Exactly. Excuse me. We're going to continue where we were from yesterday. First thing, though, I want to do a quick review on put call parity when there is a dividend. And there's one right now that pays a dividend this week that we're going to look at live right now, so we can at least see how the dividend plays into this. So Alibaba, where did that just go? Where did my Alibaba screen go? There you are. Okay, Alibaba. Stock is trading 120 and a half. Okay. Alibaba pays a $1 dividend. I'll write this up here. And the X date is Friday. Okay, so when we come into the market opening on Friday morning, Alibaba will be trading $1 lower due to the dividend that they are paying out. Okay, is that clear? Meaning, let's say, okay, pure example here, let's say this was tomorrow afternoon, close of the market, Thursday afternoon, and Alibaba closed at 120.50. Friday morning, that stock would open up 119.50 as being unchanged because they paid out that $1 dividend. So again, if we know that a company is paying the dividend, and what that does is reduce the value of that company, right? Because they're getting rid of cash. We have to, the option market has to price that in. Okay, so let's take a look at this. Let's look at the 120 strike for this Friday, June 13th. Okay, with the stock trading 120 and a half, we would think that the calls should be trading higher than the puts. Wouldn't that make sense? The 120 strike calls are in the money. The 120 strike puts are out of the money. So if we were to look at this, okay, if we were to look at these 120 prices here, the call and the put, we right away should be able to look at this and visualize and say, whoa, something ain't right here. How could the 120 calls be trading less than the 120 puts? And when something doesn't add up there, as we talked about yesterday, it's for one of two reasons. Either one, there's a dividend, or two, it's an illiquid or hard to borrow stock where puts are inflated. So right away, you should look at this and say, there's no put call parity here. Something's out of whack. Does that make sense, everybody? Okay, so what these prices that we see here on both the 120 call and put, they are reflective of what those prices would be as if the stock was trading, and we're live now in the market, 119.52. Okay, at 119.52, it would make sense that the put is more expensive than the call. At 120 and a half or 120.52, the call you would think would be more expensive. But because of this dividend and because we know this stock will be trading lower, because it is worth $1 a share less, that has to be reflected in the price of the options. Is that clear to everybody? Okay. So now let's talk about the next part of the Greeks, which we don't talk about a lot. And that is the impact of interest rates. Okay. And the Greek for interest rates when it comes to option pricing is rho. It's the Greek letter rho. Okay. So let's walk through how interest rates affect the price of an option. Okay. For a very long time, up until a few years ago, when we were not in a zero interest rate policy environment, but when rates were negligible, 1%, 1.5%, okay, rho, interest rate factor, really made no difference, to be honest with you, in the calculation of the price of an option. Okay, it had just a very, very minimal impact. However, as interest rates moved higher and higher and higher, that absolutely has more of an impact on the price of options. Why is that? Okay, let's go through what I have written on the screen here. Okay, now, if you are borrowing funds to buy stock, okay, and most of the time in your account, if you're trading on margin, and let's say you want to go buy 100 shares of stock of NVIDIA, which would cost you, right around $14,000, okay, more than likely you are borrowing money from your clearing firm, from your brokerage firm, okay, to purchase that stock. Okay, if you are borrowing money to do that, you are paying an interest rate back to your brokerage firm. Okay. Oh, hang on one second, guys. This is the 10-year note auction. Just the results just came on, and they must be very, very positive in this auction. It must have been very well received because rates are ticking down. S&Ps are moving higher. Yeah, the 10-year is now down to 441. Okay. We can come back to that in a little bit, but it's really, um, really coincidental that I'm looking at this 10-year auction and we happen to be talking about interest rates right now. Okay, so back to this. If you have to borrow money to buy something, there's a cost to that. Okay, what is a replicated position? Instead of buying stock, if you are bullish on a stock, you can buy calls, right? And look for an upward move. Well, if you're buying calls instead of replacing buying stock, those calls have to be priced with whatever that interest rate sensitivity would be. So as rates are moving higher, that makes call options more expensive, put options less expensive. Okay? Does that make sense? Well, in a married put situation, Robert, you have long stock and you have a long put. Okay? So that put is going to be a little less expensive premium wise than the call is because of where interest rates are right now. If we were in a zero interest rate environment, that put call parity would be exactly even. Okay, so let's look at the bottom part here of what I have down here. Okay, so let's say you want to have a fairly neutral position, a delta neutral position. I mean, that's the way I always traded when I was trading on the floor. Always wanted to be as close to zero deltas as possible. Okay, so if I have a short call position, what is my hedge to that? To get back some positive deltas. Because if I sell a call or sell numerous calls, that's bearish, that's going to give me negative deltas. So one way of hedging that is buying stock. Okay, so long stock, short call, just like a covered call position. Okay, but if I am buying stock, that requires capital. That requires capital. So if I am going to sell calls and buy stock where I know I am going to have to pay an interest rate to my brokerage firm, that spread or that interest rate portion of the price needs to be included in the price of those calls. Okay, does that make sense? Higher rates will affect the price of calls, make them more expensive, and will affect the price of puts, making them less expensive. Okay, now on the opposite end of that, instead of just a short call position and long stock, okay, what if we have this position on? Okay, let's say, again, I want to be delta neutral, okay, directionally neutral. Let's say I've sold a put. Okay, what would be a delta hedge to that? Obviously, I can either buy another put or I can sell stock. Right? I could sell, let's say, 250 delta puts and sell 100 shares of stock and have a neutral, a directionally neutral delta neutral position. Okay, everybody following along? If I have this position on, I'm actually going to be collecting interest because I am selling stock, basically loaning someone else the funds. So I will be collecting interest. So the fact that I am collecting interest will make the value of the put option less. Just like if I'm paying interest, it makes the value of that call option long or more expensive. This is the opposite. So the higher and higher rates go, the more disparity you will see between a call and a put. Let me see if I can move my picture here. Let's see. Nope, don't want that. That's for sure. There we go. How's that? Does that work better? Well, selling stock is shorting stock, Bill. If you don't already have a long stock position and you're just selling stock because you don't have an inventory of it, that is shorting stock. Okay, let's go through an example here. Okay, here's an example. We'll try and make this as simple as possible. Okay, I want to sell a 1-year call option, okay, on a stock that's trading 75 bucks. And I'm going to sell the at the money 75 call. Okay, if the 1-year interest rate, like I have up here, is 5%, okay, the cost of borrowing $7,500 at 5% would be $375. Now, probably asking, why are we borrowing $7,500, right? Anybody wondering that? Anybody? Or everybody understands that? I would not expect that, because this is pretty intricate here. Okay, so remember what I explained. If I had sold a call, my hedge to that is buying the stock, right? So if I sell a 75 strike call and I buy the 100 shares of stock at 75, that's 7,500 bucks that I'm borrowing to buy that stock as my hedge against selling that call. At 5%, that's going to cost me 375 bucks for the year. Okay, does everybody follow the math there? Okay, that means then the price of that call option, without anything else playing into it, not even thinking about volatility or anything, the price of that call option has to be at least $3.75, which would be the cost of what the interest on a long stock position would be. Is everybody following that? Absolutely. Absolutely, Bill. It would 100% be more than $3.75. But we know that $3.75 would be added into the price of that option because of interest rates. Does that make sense to everybody? Okay, I am looking over here. Here we go. Let's take a look at UNH. Okay, we're going to go back to put call parity here. Live example. Okay, here's UNH, United Healthcare. The stock is trading 309.78. If we look at the money, the 310 call, the 310 put, I don't see any difference there. What does that tell you? What does that tell you if they are right in line? Parity, exactly. That means there's probably not anything going on, right? No dividend, no big interest rate issue, okay? But now let's look at next week's options. Let's look at next week's options. So now let's go to the 310, and all of a sudden here, oh my God, this is so out of whack. If we are right at the money, as we saw for the options expiring this week, we should be almost spot on with call and put prices for next week, right? But we see a huge difference. Over a $2 difference in the price of that option. What would we think? What would we go to? What is that telling you? Especially since we know United Healthcare is a stock that's not hard to borrow. There's no liquidity issues. What does that tell you? Excellent. And yes, they do have a dividend. Not this week, because none of the options for this week were affected. But if we look, United Healthcare pays a dividend June 16th. So that's Monday, next Monday, of $2.21. So that's why the options this week with the June 13th expiration are not affected. But the options that expire next week have to include the fact that the stock will be $2.21 less Monday morning. And that is reflected in these prices here. All right, let's get to our word of the day here. Yeah, let's get those rates in there. Also, guys, I know that I've mentioned this before. I'm getting a little tired of seeing the Hulk up here. So if anybody has any suggestion of how we can replace this guy here, what we can replace him with, I am all ears. We started out, if you remember, those of you that were with us when Market Minds started, we started out with Groucho Marx. We went to the Hulk. Now, I'm getting kind of sick of seeing the Hulk every day. So I'd like to come up with something new. Now, I can always do a Cubs logo, but that may not be appropriate for everybody. An open mouth shark, W.C. Fields. Marlboro Man, I love the suggestions here. Keep them coming here, guys. Thor, oh man. You know what? I love that. Maybe we will do Thor. Wonder Woman's a great one also. Jeffrey Lake, we are going to have to get a great picture of Thor. Hopefully nobody really dislikes German Shepherds. Thor is a great dog. I like that. All right. Any questions here? Shrek. Shrek is a good one too. All right, make sure you get that up here, guys and gals. So the biggest thing to take out of put call parity, guys, the biggest thing is the amount of premium, the amount of extrinsic value, the time value, okay, the theta has to be equivalent between a call and a put, same strike price, same expiration. And if it is not, the antennas should go off. There's something going on, either stock's paying a dividend or there's a liquidity issue with the stock. And the reason why it is so important is because of this. It is because of the relationship of options to one another and how we can combine different options different ways to get to a certain outcome. Yeah, you know what, Valerie? Let me get that right now. Hang on, I'll get you guys a link. Can I please have a link to this? Hang on one second here. And you know, this is always on our YouTube channel to rewatch, re-listen, review. But I will have a link up here shortly for you. They're working on it right here in real time. So this synthetics strategy or strategies, okay, from this first equation right here, you can get to all of the outcomes. All right, link is coming here. I think the wheel is closed. There we go. I got the link now. Danny, thank you very much. Glad I got such a great team with me. Here is the link to the presentation. Everybody see that posted in there? Excellent. All right. It is maybe for the, good wheel today. Maybe for the last time, the Hulk spin the wheel. Okay, yesterday's winner, I'm going back here, was Karen. And for all of you who are waiting on your goods, there's going to be a big batch getting sent out this week. So if you haven't received your swag over the last week or so, okay, it will be out shortly. All right, here we go, everybody. Wheel is in motion. We got Elisa, Eric, Frank. Who are we? Eric. I know you were earlier. I saw you answering a lot of questions. And yes, please hit that thumbs up and smash the like and everything there. Eric, are you still in the house? I know you were here. Oh, man, just got new. Oh, Eric, wonderful. Okay, you know what to do. We'll post it up here. You got to shoot me an email with your mailing address and your size swag, and we will get you out some swag. There is the email address on the screen. Anybody, I'm just seeing this on the tape right now. Anybody that's a Beach Boy fan, Brian Wilson just passed away. Bummer. Bummer, bummer. All right, everybody. Well, that 10-year auction that came out as we were talking 15 minutes ago or so, market definitely likes that. Seeing the S&P's up about 15 points right now. The Dow is up 250 points. NASDAQ's, slightly in the green, 26, 27 points or so. Thank you, everybody. Appreciate all of you. And what I'm going to leave you with today is what I talked about at the very beginning today and what we talked about a lot on last night's Coaches Roundtable. Don't over trade. Don't get caught up in FOMO. Okay? Do not. All right, everybody. Thank you so much. Have a great day.